Welcome back to Talk Tickers. Today we're taking a closer look at Westport Fuel Systems and their latest earnings call for Q4 2024.
All right, let's break it down.
So what were some of the key takeaways that jumped out at you?
Well, the first thing you notice is that Westport's revenue is down.
Down, huh?
Yeah, for both the fourth quarter and the full year.
And why is that?
Primarily because they're shifting their heavy-duty OEM business over to their Suspera joint venture.
Suspera.
Yeah, it's essentially a separate entity that focuses on their high-pressure direct injection, or HPDI technology.
Okay, so they're focusing more on HPDI. Got it.
Exactly. It's a strategic move,
Makes sense.
Anyway, Q4 revenue came in at $75.1 million. That's a 14% decrease year over year.
14%? That's a pretty decent drop.
It is, but it was kind of expected. And for the full year, revenue was $302.3 million, down 9% from 2023.
So a bit of a hit to the top line, but I imagine there's more to the story.
Oh, absolutely. The interesting part is their profitability actually improved quite a bit despite the lower revenue. Yeah, their gross profit for Q4 jumped up to $14.3 million, which works out to 19% of revenue.
19%. Now that's a solid margin.
Right, and that's a big improvement from the $8 million, or 9% of revenue they reported in the same quarter last year.
So they're making more money on each sale, even if they're selling a little bit less overall.
Exactly. And that trend continued for the full year as well. Gross profit rose to $57.6 million, again at 19% of revenue.
Wow. So it seems like they're becoming much more efficient.
It seems that way. A part of that improvement comes from increased sales to their established customers in Europe.
Interesting. So stronger relationships with existing customers are paying off.
It seems so, yeah. And then there's the whole adjusted EBITDA situation. Their losses decreased significantly.
EBITDA, earnings before interest, taxes, depreciation, and amortization. You always got to remind me.
Right. Sorry. It's an important metric, though, because it shows the company's core operating profitability.
Right. So tell me about these decreasing losses.
Well, in Q4, they had an adjusted EBITDA loss of $1.8 million, much better than the $10.9 million loss from Q4 2023.
A huge improvement for sure.
Right. And for the full year, the adjusted EBITDA loss went down to $11.2 million compared to $21.5 million in the previous year.
So all signs pointing to better cost management and overall operational efficiency.
Yeah, exactly. Now, we got to talk about cash flow. It's always a crucial factor.
Absolutely. Cash is king, as they say. How did Westport fare on that front?
Well, they actually managed to achieve positive net cash from operations for the full year. That's a pretty big deal.
First time.
Yeah, one of the first times. They reported $7.2 million for 2024.
That's definitely a step in the right direction. What drove that positive cash flow?
Primarily the lower operating losses we just talked about, and they also did a good job collecting their receivables.
Smart moves.
Including the sale of some Italian value-added tax receivables.
Ah, so they found some creative ways to boost their cash position. But what about their cash reserves overall?
That's where things get a little, they ended the year with $37.6 million in cash and cash equivalents.
Okay, and how does that compare to the previous year?
It's actually down from $54.9 million at the end of 2023.
So their cash on hand did decrease. Why is that?
It seems like a big chunk of that decrease was due to debt repayments they made during the year.
Okay, so they're being fiscally responsible, paying down debt. But it does mean their cash reserves are a bit lower.
Right. And actually, this is where things get really interesting. In the earnings call, the company mentioned something quite important.
What's that?
They projected that their current cash, those $37.6 million we just talked about, might not be enough to fund their operations for the next 12 months.
Oh, wow.
Yeah, under their current business plan, that is.
So they're facing a potential cash crunch in the near future.
It definitely seems that way.
Well, that definitely raises some concerns.
Yeah.
So how are they planning to tackle this issue?
Well, they dropped a pretty big announcement during the earnings call. They've decided to sell their light-duty business.
Wow, that's a significant move. Selling off a whole segment of their operations. Can you tell me more about this sale?
Sure. So they've signed a definitive agreement to sell this part of their business, and it's a pretty comprehensive sale. It includes their light-duty OEM, delayed OEM, and their independent aftermarket operations.
So everything related to their work on lighter vehicles, basically.
Yep, pretty much. They're getting $75.1 million in cash up front for it.
$75 million? That's a lot of money.
It is. And there's potential for an extra $6.5 million in what they call earnouts. So basically, they could get even more if certain performance targets are hit down the line.
Interesting. When is this sale expected to close?
They're aiming for the end of Q2 2025, but of course that's subject to shareholder approval and the usual closing conditions.
Makes sense. So it sounds like this divestiture is a pretty strategic move. What's the main reasoning behind it?
Well, the company's been pretty clear that they want to really hone in on what they see as the most promising areas for growth.
And what are those areas?
Specifically, they're targeting those sectors that are proving really difficult to decarbonize, like long-haul, heavy-duty transport and industrial applications.
That's a smart move.
Mm.
Those sectors are definitely facing unique challenges when it comes to going green.
Right. They believe those areas will have a harder time adopting battery electric solutions because of limitations in range and just the sheer demands of the job.
So it's more about practicality and finding solutions that can actually work in those specific contexts.
Exactly. That's where technologies like natural gas and potentially in the future, hydrogen have a real advantage.
So they're betting on those alternative fuel solutions.
Yeah, especially in those hard to decarbonize sectors. Their two core technologies for this strategy are their HPDI, which we talked about earlier, operating through their Suspera joint venture, and then their high pressure controls and systems business.
Which, if I recall correctly, is all about developing essential components for alternative fuel systems. Okay, so selling the light-duty business helps them focus on these key areas. But how will it impact their financial situation?
Well, remember how we talked about them potentially needing more cash in the near future?
Yes.
This sale is projected to have a very positive effect on their balance sheet. That upfront cash from the sale, the $75.1 million.
Right.
Well, that's actually more than they had predicted they would make from the light-duty business over the next 5 years combined.
Wow, so they're getting a big influx of cash much sooner than expected.
Exactly. It gives them more financial breathing room. This will help fund their organic growth initiatives for both Suspera and their high-pressure controls and systems segment.
So they can invest more in research and development, expand their operations, things like that.
Yeah, and it also gives them more flexibility to explore strategic acquisitions in the future.
Acquisitions, huh?
Potentially, yeah.
Yeah.
You know, buy up companies that align with their overall focus.
That makes sense. So they're not just selling off a part of their business, they're using that to really double down on their core strengths.
Exactly. It's a pretty significant pivot.
It really is. Now let's dive a little deeper into HPDI and the Suspera joint venture. What's the latest on that front?
Well, they shared some encouraging news about HPDI. Production volumes from their main OEM customer actually increased in Q4.
That's great news.
Yeah, and they expect this trend to continue into 2025. It's a good sign that HPDI is gaining some traction in the market.
It definitely suggests that there's growing adoption of the technology.
They also mentioned that they're talking with other potential OEMs about adopting HPDI.
So they're actively seeking to expand the reach of their technology.
Yeah, and they're seeing a lot more interest from potential customers. They think it's partly due to a renewed focus on natural gas solutions in the heavy-duty market.
Interesting. So even with the big push towards electrification, it seems natural gas is having a bit of a comeback.
Yeah, and Westport is in a great position to capitalize on that. They have the technology and the expertise.
It sounds like they're striking a balance between adapting to current market demands and staying ahead of the curve.
Right. They see the long-term potential of hydrogen, but they're also being realistic about the current market.
Okay, makes sense. Now, what about their high-pressure controls and systems business? What's happening there?
Well, this segment has been seeing a lot of growth, especially in hydrogen components. They've managed to secure some big contracts in that area.
So they're making inroads into the hydrogen market.
They are, although it's still early days. Production for those hydrogen components is probably 2 to 3 years away.
Got it. So the hydrogen play is more of a long-term strategy.
Exactly, yeah. But they're also being very savvy about what's happening right now, particularly with CNG, compressed natural gas, in North America. It's gaining a lot of momentum.
CNG is making a comeback.
Yeah, and Westport wants to capitalize on that momentum.
How are they doing that?
They're taking their expertise in high-pressure systems, which they've developed through their hydrogen work, and applying it to the natural gas market.
So they're leveraging their existing knowledge to create new opportunities.
Exactly. They're developing similar components and systems specifically designed for CNG.
Smart move, very efficient.
They see this as a very real opportunity in the near term because, well, the core technology is pretty much the same. It's all about high-pressure systems.
Makes sense. And it seems like a natural progression from their hydrogen work.
Right. They're also looking to shift this segment from being just a components provider to offering more comprehensive integrated systems.
So moving up the value chain, becoming more of a one-stop shop for CNG systems?
Exactly. They're thinking about acquisitions to help with that as well.
So buying up companies that can help them build out these integrated systems.
Yeah, it's a pretty smart strategy, and they're initially focusing on North America for this, but they definitely have global aspirations.
Ambitious. It seems like they have a solid plan in place. Now let's talk about their debt situation. After selling the light-duty business, what will their debt look like?
They mentioned that they'll still have about $7 million in debt after the sale.
$7 million, that's a manageable amount.
Yeah, especially considering most of their current debt is tied to the light-duty business that they're selling.
So this sale will significantly reduce their debt burden.
It will, which puts them in a much stronger financial position moving forward.
Absolutely.
Right.
Now, I'm curious about their research and development capabilities. Will selling off the light-duty business impact their ability to innovate in their core areas?
They were pretty clear about this. Their R&D and engineering for the high-pressure controls and systems business is based in Cambridge, Ontario.
Oh,
And that's completely separate from the European light-duty operations they're selling.
so their core R&D team remains intact.
Exactly, which means they can continue to innovate and develop new technologies for the heavy-duty and industrial sectors.
That's a big relief.
Yeah.
So to sum it all up, they're selling a big part of their business to focus on decarbonizing the heavy-duty transport and industrial sectors, and they're doing this primarily through their HPDI technology and strategic expansion of their high-pressure controls business.
That's a great summary.
What are the key takeaways that investors should be considering?
Well, I think the biggest takeaway is this is a big strategic shift for Westport. They're really focusing on sectors that have the potential for higher profit margins and significant growth, especially as the world grapples with decarbonization.
Right.
And then there are the improved gross margins and the significant reduction in those EBITDA losses over the past year. It shows they're serious about operational efficiency and managing their costs.
Which are crucial factors for any investor.
Absolutely. And then you have that milestone of achieving positive cash flow from operations.
For the first time.
Exactly. That can't be overstated. It shows their underlying financial health is improving.
Agreed.
Of course, they're also saying they'll need more funding in the next 12 months, which is why that sale of the light-duty business is so crucial.
Yeah, that cash injection will really help them move forward with their plans.
Right. And the money from that sale is going to be huge in strengthening their financial position. And then there's their focus on natural gas and biogas as more immediate solutions, while also keeping an eye on the future potential of hydrogen.
It seems like a smart and balanced approach, wouldn't you say?
I'd say so, yeah. They're really trying to address the needs of today while preparing for what's coming down the line. And that pivot towards the North American CNG market with their high-pressure controls business, that's just smart business. They're being adaptable, responding to the current market dynamics.
They are definitely positioning themselves to take advantage of the opportunities that are emerging in that space.
For sure.
All right, it's time for our This Is Not Financial Advice segment, where we take all of this information and try to come up with a crazy yet plausible trade idea.
Okay, I like this part.
What kind of contrarian play are you seeing here after dissecting this earnings call?
Okay, well, let me throw this out there. Westport is going all in on natural gas for heavy-duty applications, and they're getting ready for the hydrogen economy. They're leaner, meaner, and they're about to get a nice chunk of change from that sale.
So far, so good. I'm intrigued.
And when you zoom out and look at the broader energy landscape, there's so much pressure right now to reduce emissions.
Sure.
Everyone's talking about electric vehicles for personal cars, but heavy-duty trucking, that's a whole different ballgame.
Absolutely.
So here's my crazy idea. Westport's more focused now, their balance sheet is looking good after that sale, and the world is realizing that natural gas is actually a decent transition fuel for trucking, especially in North America.
Okay, I'm with you.
So why not go long on Westport Fuel Systems? Bet on them to capitalize on the growing need for natural gas in heavy-duty trucking. To make it even spicier, pair that with a long position in a company that builds infrastructure for renewable natural gas, RNG. Yeah, think of it as a more eco-friendly version of natural gas. If the demand for natural gas and trucking goes up, the demand for RNG should follow.
Interesting.
And now for the really outrageous part, maybe short a big electric truck manufacturer. Just a thought, playing on the idea that the switch to electric for long-haul trucking might not be as smooth or as fast as everyone thinks, that could give natural gas solutions more time to shine.
I like it. A bold, contrarian play. Of course, this is all purely hypothetical, not financial advice in any way.
Absolutely. Just a fun thought experiment.
Exactly. All right, that was your in-depth look at Westport Fuel Systems Q4 2024 earnings call. We covered their financial performance, that major decision to divest their light-duty business, and their strategic focus on HPDI and high-pressure controls. Hopefully, you now have a better understanding of where the company stands and what their future plans are. What do you think about Westport's new direction? Do you think that increased focus on the North American CNG market is a big opportunity for their high-pressure controls business? Jump into the conversation and let us know your thoughts. And don't forget, that trade idea we talked about, purely speculative, not financial advice. Thanks for tuning in. Talk Dickers.